All right, so as a trader, there's absolutely no way that you are not going to interact with the charts, and that's the main reason why we are making this video, the basic technical analysis concept. That's just the main reason why we're looking at this particular topic. Okay, so we want to look at how to make sense of the charts. These are some of the things that I look at that helps me to make sense of what's going on the charts. So I'm gonna be, showing you the chart patterns that I look for. So we're going to look at those basic chart patterns and then the ones that I actually pay attention to when I'm looking for reversals. And then we're going to look at candlestick patterns also for confirmation. So, when we want to take entries and all of that stuff, or when we want to convince ourselves that the market is turning at a particular level, then um, you know, then we can use candlestick patterns to help us confirm that. And then we're also going to be looking at trend line for trend analysis. So trend lines can help us to actually monitor the trend analysis. Then moving averages for also trend analysis. Okay. So now one thing that I want you to understand is that this is not the video where we talk about entries. Like I said, we're going to be looking at chart patterns, candlestick patterns, trend line, and moving averages. Now, the one that is not included here will be reference points, okay? And I want you to keep that in mind because it's very important. Now, I did not include it here, but that is very important, okay? So reference points, that has to do with key levels, okay, in the market. And the reason why I call them reference point is because lots of people refer to those areas on the chart. They are widely reported, and what I'm referring to here is the daily high, okay, the weekly high, the monthly high, you know, and the yearly high. So that would be reference points. Okay, so that those are very very key. So for instance, if price trades and break through, so let's say for instance we have a particular high for a week. So let's say this is the weekly high. So weekly high, okay, and then a new week opens, right? So let's say this is coming up. So a new week opens, and then it breaks through that former week's high. All right. So this can be very big information for us to actually find out what is going to happen, or what is most likely going to happen in the trend. So it is most likely that price. Now sometimes it happens. Not shouldn't say it's most likely because sometimes the momentum can be very strong and it doesn't come back. But sometimes you can have this happen, and I've seen it happen a lot. So, but you can have market after breaking through like this come back to retest that high because this is a very significant high, okay, and then if the trend is going to continue, it continues from that point. So weekly highs or lows, daily highs or lows, monthly highs or lows, and yearly highs or lows. So those are really really significant reference points for the market because it's widely reported. Okay, so those levels, like I said, can be used as key levels. When market breaks through those levels can act as a support or resistance, okay, for price. Okay, so just as the case may be. So for instance, if it is like this, when price breaks through the high was resistance, and then it could act as support for a continued bounce. Okay, now you would see exactly how I use this concept in when we talk about entries, because this is one of our ways for entry, but you will see other things that are relevant when we are looking at such type of entry. Okay, but for simple trend analysis and trying to make sense of what is happening on the chart is a very important concept for you to monitor these reference points, and then like I said, we can use that as levels where we expect to see price coming back into, and then we can look for entry points. So weekly highs, weekly lows, daily highs, daily lows, yearly highs, yearly lows, monthly highs, monthly lows. Okay, so reference points, very key. All right, so the next one we're going to talk about chart patterns, then candlestick, trend line, then moving averages. So let's go into that right now. So the first right here we have is, you know, just this is the basic trend patterns for the market. So first you have the uptrend. The uptrend is when you have higher highs and higher lows. Okay, I guess you must have seen this on your chart before, but this is a simple uptrending pattern. Okay, so price is showing us that it is moving in an uptrend, and so it's going to be creating this higher highs and higher lows. Okay, so that is uptrend. Now the opposite of it is a downtrend, so where the market is creating lower highs and lower lows. Okay, now I've actually done a full video on basic um basic what should I call it now? So basic chart reading. All right, so I should just call that basic chart reading on my YouTube channel, and you can go search that out. Okay, so but if you're not having an uptrend and you're not having a downtrend, that means that you are having a trendless market, or you can say a sideways market. So a sideways market is one that is not actually creating higher highs and higher lows, and it is just moving sideways. It's not creating higher highs and higher lows, and it's not making lower lows and lower highs actually. So it is actually not showing you a clear trend. Okay, so a clear trend is here where we have this higher highs, higher lows, and price retrace creates an. This is what you call an impulse leg. Okay, so let's just point that out. This is an impulse leg, and this is a correction. Impulse leg correction, impulse leg correction. So when the impulse leg is going to the highs, all right. So when the impulse leg is to the is you know going northwards, that is an uptrend. If we have a downtrend, then the impulse leg should be facing down, and the corrections should be back to the upside. Okay, so but sideways trend, we are not moving in any clear direction, so it's just moving sideways. So when we are in this uptrend, it is showing us when we're in this is called the bullish trend. So when we're making higher highs and higher lows, the market is showing us a direction that is going upwards, and lower lows, lower highs, downward trend. And then if it's moving sideways, then we know that the market is not showing us any clear trend, and probably it is making preparations for a reversal, or it is actually just taking a pause and then could actually continue. Okay, so that is for that one. So the next one I want to look at here is the heads and shoulders pattern. Okay, there are actually three of them right here. So we have the heads and shoulders pattern, and then the double top double top and double bottom with a stop hunt. Then we also have double top and double bottom with failure swing. So these are chart patterns for reversals that I like to pay attention to. And um we've actually touched we've looked at double top and double bottom before. Now we've used it actually in this particular series of video when we were looking at, I think, railroad technique, right? Maybe railroad technique or thereabout. So but we did say that a head and shoulders pattern is you know a very good chart pattern for reversal, and you also have the inverse head and shoulders pattern, which is bullish. It's a bullish chart pattern. This is bearish. This is the head and shoulders pattern. So you see a left shoulder, you see the head, and you see the right shoulder. Okay, now for me personally, this is my preference. Actually, I really love to see that after this, left shoulder has been created and the head, and then when this head has been completed, that's the swing you see right here. I'd like it to break this low. Okay, the reason why I love it to break this low is because of, I want that lower low to be created, okay, in order to respect the basic trend pattern of lower low, lower highs. Okay, so I just love it to be like that. But even if it is not like that, I want to point out something to you. If you have this swing here, this price movement to the downside, if it is about equal to this, it is still very, very meaningful. The reason is because of this. You got to look at the meaning, or the significance of this particular chart pattern. So price is making a higher lows and is making a higher lows and higher highs, right? So this was a higher high, and this is also another higher high. Okay, so this is the impulse leg, okay, creating that higher high. So impulse leg is showing us momentum. That is where the strength of the trend is invested in. The strength of the buyers is invested in that phase, and so that's why I see that big push of price to the upside. Now, um, if we have this retracement coming back down to cancel that move out. So let's say it is equaling, it goes back to the origin of that impulse leg and just stops there. It is significant because now we've seen that the strength of the buyers have been cancelled out by that move back down, all right? And so that makes sense. So when the market goes ahead to form a lower shoulder or a lower high, which is of course a um the right shoulder. So we went from impulse leg to impulse leg, then creating something like a correction. So this was an impulse leg and an impulse leg to the downside that cancels it out, which is why it's significant. All right. And if it breaks through the low, then it makes more sense, right? And then it comes back up to create this right shoulder, and then we can expect to see downward price. Okay, so the inverse head and shoulders pattern is just the opposite of this one. All right. So when you have this kind of chart pattern, you should be expecting to see bearish trend. If it is inverse, that means it is upside down. So what we have, um, you know, something like this. Just draw that out, something like this, right? Okay. So when we have something like this, then we should expect to see, bullish prices, right? Okay. So the next one we have here is the double top and bottom with stop ons. Now this one right here is also very significant. It's just a simple formation. It looks like the M, but the right um the right top is higher, a little bit higher than the first one, than the left one. Okay, so just exactly this picture we have here, you can see that this top, okay, was higher than this one right here. And the reason for this is because when the big boys want to trade, okay, so let's say for instance they want to sell, all right, um what happens is that they trade in large volume, and then they will need so much counter side volume or counter side liquidity actually to trade, to enter. So if they want to sell, they will need buyers to come into the market, or they will need that area, that price point where we have lots of buyers that will come into the market. That is the ideal location for them to sell, or that's the ideal price range where where they will be initiating their sell orders. Okay, and the opposite is also true if they want to initiate buy orders. So they'll be looking for that region or price range where you have lots of sellers coming in, and that's where they will want to, initiate their buy orders. So what we have here is, the double top with a stop on, all right. And so here, when the market retraces back like this, people will be seeing this high as a resistance. And there are actually people who will be here selling the market. And that is where they're putting the stop loss above that point. Now, a seller's stop loss is a buy side liquidity, because when you sell, you need to buy back a position in order to get off a trade. Okay, so the easiest way to get it is if I say the other way, that when you buy as a trader, you need to sell in order to close that trade. Okay, whether in profit or loss, it doesn't matter. If you make profit, it means that you are, let's say for instance, you buy, and for you to make profit, that means you have to sell at a higher price. Okay, if it's in a case where you lose, that means when you buy, you are forced to sell at a lower price. Okay, so but either way, you are selling after buying. All right, so for the buyer to exit his or her position, he or she has to sell that position to exit it. And so it is also true when you short the market. That means when you sell the market, you have to buy back that position. Okay, the whole idea of shorting the market is this: when you short the market, that's a kind of setup where you actually borrow. Okay, you borrow from the market. You actually borrow from the I should say the market maker. All right, so you borrow from the market maker, and then so in the first case you're actually buying. All right, you bought and then you sold off. But in this case, you borrow, right? And then when the market goes down, okay, so what you want to do is to buy back again. I don't know if you get what I'm saying now. So you buy back again. So you borrow from the market maker, and then you sell it at a high price, and you're expecting the price to go down so that you can buy back again. That's just the whole idea behind short selling. And just to keep it simple, what we say is that you sell the market. So when you sell, for you to get out of your trade, whether in profit or in loss, you have to buy back your trade. So your stop loss that you set above the high when you sell here is a buy order. Okay, and so when price comes back above there, understand that the moment that triggers, that will become buy side orders in the market, because for you it is actually you are getting out of the trade, but buy orders are being flooded into the market. And also you understand that it's not the stop losses here that are the only buy orders in the market at that point, because this area has now been seen as a resistance, and lots of people might be looking at that and saying, all right, I have a decision to buy this market. I want to buy this market, but I need the market to convince me that it is going higher. And so, for some people, they're going to be waiting here to see if the market makes a breakout, and that is when they're going to be initiating their buy orders. So, there you go. You have new set of buyers coming to the market. First, we have the people who place a stop loss um, after placing their sell positions when price is going down. But then you have another people who are believing that the market should go up, and then they wait for that breakout, and they're going to be initiating their buy orders at that point. So what you have is now groups of traders who are buying at this area. So above highs, right there, you have those large buy orders. If it were, something like this, then the opposite would be the case, where you have people will be waiting for the breakdown here to sell this market if the belief is going down, or people who were believing it was going up. When they see this market bounce here, they would have been buying it around that level and putting the stop loss there. All of that is going to be sell side liquidity, which is great for the market makers or the big boys, big speculators, to actually use to go long. So market breaks up, all right, grabs liquidity, and we see a breakdown. So when this is happening, I can be confident, or I can come into the market and say, yeah, I'm spotting a reversal probably. And the greatest confirmation is when you have price break through the neckline. So this is the neckline, okay? Or if we are having it breaking, going to the upside, if it breaks through the neckline there. So that's the neckline. So when it breaks through that neckline, then we can say the double top reversal is confirmed, and we can choose to look for sell trades. If you've not taken it right here, okay, if you've not taken it at that high right there. All right, so that is the idea behind the double top or double bottom with a stop on. The third one right here is the double top, okay, or bottom with a failure swing. So all of these three guys are reversal chart patterns. Okay, I look for these chart patterns. Not as if I go into the market to look for them every day, but when I see them, it helps me to, you know, like think or begin to, or at the very least, to pay attention to what the market is doing. So I'll be looking for reversals, all right, in the market, and there are times when this can actually help you spot very early moves, especially when you combine them with the candlestick patterns. All right, so the third one right here is double top and double bottom with failure swing. So the first one was a stop on, okay, a stop on. This move right here, when it broke out, it caused more people to rush into the market to sell, to buy the breakout, or when it broke down here, it caused the market people to rush in to sell the market. So that is a double top and double bottom with a stop on. But right here, this is a double top and double bottom with failure swing. And what that simply means is that here you will see them pushing the market down very strongly, and probably this could be a very volatile move in order to get people excited about the whole thing. So you can have people selling um, because of fear. So there's going to be panic, or there's going to be um, a bubble like what we saw in Bitcoin some time ago when it was around 60,000. But right now we've seen it retrace um, very strongly. Okay, so right that time when it was around 60,000, 60 something thousand, you had people so very excited. Oh, Bitcoin is going to whatever, going wherever, and it was all over the news. It was as if the big boys were just sponsoring it, not knowing that they understood what was going on, because they are very they have this highly leveraged position in the market. So they've taken so much leverage on the Bitcoin longs, and so they're looking to get out of their positions before it is too late. And when is it going to be too late? Just like what we shared with you guys in this course already, we said that when the monetary policymakers begin to tighten the monetary policy, then that's not really too good for Bitcoin, because anybody who took leverage now to get into that trade now has to pay more. If you have to pay more for that existing loan or existing debt. And also, what makes Bitcoin attractive is going to, you know, like decline. It's going to decrease. Um, the reason why Bitcoin is so attractive to people is because of inflation. So when they begin to raise interest rate, that's the monetary policymakers, then inflation expectation is most likely going to drop, and the yield is going to attract people because Bitcoin does not offer any yield. But now the money, right? The fiat, the currencies now are offering yield. So when people want to make a choice, should I go for yield? Should I go for currencies, or should I go for Bitcoin? So it makes sense for people to go to currencies that actually provide yield. So at that time, it's no longer i- you know interesting to people to get into Bitcoin, and so that is why it seemed to me that that's why the big speculators were just about, were all over the news talking about Bitcoin and all of that stuff. And it caused lots of uninformed trader to get in at that very high price. So that is an example of a bubble. Okay, so people got into the trade, but they never had the chance to get out of it. So you just see that people get in, all right, at that very end, and then price will retrace from that point aggressively back into the range, just like what we have here. Price got to the low, so let's just assume this is a panic selling. People get in, begin to sell the market very aggressively, and then market retraces back. Okay, and then they never see that price again, so they never get a chance to get off that trade again. All right, so they might just be waiting right there and saying that, okay, it is coming back, so you can have it here. Let's say it is coming back. Okay, it's coming back, let's say a little bit more, and just wait so we can just close off more profits. So you have people doing that, people averaging. Okay, there's actually a story that I heard of one guy who traded for a very big institution and lost billions of dollars simply because of this simple this stuff right here, averaging in, expecting the market to come back, expecting the market to come back, and all of that stuff. But the market kept pulling away and away and away from him. So a lot of people do that at different levels. Okay, so this is one chart pattern. So this first one right here, we had the stop ons, but this right here, it is like they create this panic or bubble, and then people get involved, and then they move price back. Okay, and then never have the opportunity to see that again. Okay, and so this right here also is another chart pattern that I think is good to monitor for reversals. Okay, so let's go further, guys, and right. So let's look at the candlestick patterns. Okay, so candlestick patterns. These candlestick patterns are very good for confirmation, um, especially when you combine them with, you know, your chart patterns, for instance. So let's say we're looking at, let's say price broke a daily high, a weekly high to the upside. So we're seeing a retracement back into that high. So let's say we're expecting to see a bounce. If we're expecting to see a bounce, what should make us buy that move? Okay, you're not just going to jump in because you see price trading into that from a high. All right, so let's just assume that is your trade idea. You're not just going to be trading because price trades back into that from a high. You get the point now. You're not going to do that because price can actually continue to the downside. All right, so but the only reason why you can trade that is when you have some form of confirmation, and that is where candlestick patterns come in. All right, so you can also have a chart pattern like a stop on like this. So when we talk about entries, you find out that this is also one of our entry techniques, but you have to include a candlestick pattern around here. That's after doing your fundamental analysis. But the only reason why you can actually trade with chart patterns like this, and find a good entry, would be using it with candlestick patterns. So you want to see that you have a candlestick pattern around here that kind of confirms to you that the market is most likely going to reverse back to the upside. Okay, so that's why candlestick patterns are very important. They can help us spot the move earlier on so that we can get in at a very good price. So here are examples of the candlestick patterns that I like to look at. We have the bullish engulfing pattern. So here, and I'll be walking through, what these patterns actually mean for us. Okay, so for some of you, you might have already gotten all this information, so there's no problem about that. But we have to carry everybody along, right? So, but the bullish engulfing pattern right here is a very simple idea. All right, it is just showing us that there's a change in momentum. All right, so it's just like a momentum loss and momentum change all in one. Okay, so let's say for instance, initially you have a downward price movement, and um, price gets into an area you consider to be resistance, or simply price is making this um, you know double bottom with a stop hunt, and then around this level here, and let's say you've been expecting to see that price should move back up. Okay, so around that level right there, you see the bullish engulfing pattern. It simply means that the momentum to the downside is lost, and then there's a change. All right, because this right here is showing us that buyers are coming into the market strongly. Okay, so that's just exactly what it means. And so if you see the bullish engulfing pattern there, that could be a confirmation for you to actually look for long. So we're going to be using that um, in our trade as well. When we're looking for trade setup, wherever it's applicable, we're going to be using you know chart candlestick patterns to actually help us spot or confirm our entries or setups. So that is the bullish engulfing pattern, where you have the next candle engulfing the previous one. Okay, so but remember, we're not looking at the candlestick patterns in isolation. We look at the candlestick patterns with chart patterns or with key levels. Okay, when price trades into a key level, that is when you want to be monitoring for candlestick patterns, or when prices has formed, like a chart pattern, like a double top with a stop on, or double top with a failure swing, or the head and shoulders pattern, then you can look for candlestick patterns. Okay, to actually help you get in earlier. So the candlestick pattern here, this is a bearish candle, and then you have a bullish candle. So you can see that the bullish candle totally engulf, like totally envelopes the bearish candle. Okay, so that is actually an engulfing a bullish engulfing pattern. So here, um, it's a bullish engulfing pattern, and if it's a bearish engulfing pattern, then that means that this is going to be a bullish candle, and then you have a bearish candle totally engulfing it. So the candle that engulfs it is actually what gives it this name. So if it's a bullish candle that engulfs, then we say it's a bullish engulfing candle. If it's a bearish candle that engulfs, then we say it's a bearish engulfing candle, candlestick pattern. So this next one right here is bullish Arami, and the idea also is very simple. This is a loss of momentum. Loss of momentum. It's not really a change of trend yet, but it's a loss of momentum. So what it means actually is that, let's say for instance, price is has traded to a level where we expect to see a reversal, and then you have something like this happening right there. Um, it is showing us that this trend, which was uh, moving to the downside as price got into that level, um, that momentum has lost or has been lost. And so this is actually a loss of momentum candlestick pattern. All right. And that could also be a good confirmation pattern for early entries. So you got to keep your mind on that. Look at those candles very well and understand just the ideas behind it. And I don't just want you to cram names and everything, memorize names, but I just want you to understand the ideas behind it. Okay. So here we have the hammer. All right. So the simple name I call it is rejection candle, and you can see what it simply means. Price was trading down, and then on this day, it looked like it was going to trade down even further, but then rejects very strongly. So this week right here, all of this was bearish candle before. So let's say price opened there, traded down, 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 and then rejects from that low. Okay, so this one is a very good one. I like to see this a lot. I love this one. Okay, so if you have the opposite of this, I think that is called the hanging man, or maybe the whatever you want to call it, guys. Is the bearish, is the engulf, is the sorry, is the rejection candle. Okay, I just like to call it rejection candle. This is hanging man. It's a little bit different. Okay, but I like this one best. I really love this one better because of its formation. Okay, I love this one better. So, but this is your hammer, okay, or rejection candle, as I love to call it. Okay, so it's also very good for spotting, um, you know, earlier moves. Okay, so that you can get in at a very good price. So the next one right here is the morning star. Okay, the morning star, and what this means is two. It means two things in one: a loss of momentum and also a change of momentum. Okay, so you can see a shift of momentum. So you can see right here that the market dropped down, and then we had this little candle. After a very big candle, you have a small candle here showing that there was really a loss of momentum right there. So price couldn't go down further, and then you can see there's a gap. It actually makes a gap, so it comes, makes a gap, but comes back up. Okay, and then gaps again the next day to the eyes, and again and closes bullish. So that is showing us that the market is most likely going to rise. So that's why it is called the morning star. The opposite of this is the evening star, and the opposite of this is the bearish Rami, bearish engulfing. But this right here is the engulfing man, or the hanging man rather. Sorry, the hanging man, and it is also a good candlestick pattern, and it's a very simple idea. You can see we have bullish prices, and then it gaps to the eyes, but it didn't stay there. Okay, and then it's just standing on its own, right? Standing on its own from the rest of the candles, and that's why it is called the hanging man. All right, it gaps up but retraces back, begins to sell. This could be a very good candlestick pattern for a reversal. Okay, so remember, you don't trade candlestick patterns on your own. I just want to repeat that again. It's worth repeating again and again. You trade them in line with key levels. So when we are at the key level, or the market is showing us a chart pattern, then we can draw confidence that maybe this chart pattern is going to play out the way we're expecting it to play out based on the candlestick patterns that we are looking at. All right, so let's go further. Um, Here we're looking at the trend line. Just simple concept for trend analysis. Trend line is a simple idea where you connect the highs and the lows in an uptrend or in a downtrend. So if the market is in an uptrend, you're simply connecting the lows, and it can help you spot early trend reversals, and it can also help you um, follow the trend effectively. So for instance, here you can see the price was just bouncing on the trend line, bounce on the trend line. So hold this area right here. When you see this happening, okay, we're not saying you should use this to find entry levels. I'm not saying you should use this to find entry levels at all. Personally, I don't use it to find entry levels, but it is a good tool for analyzing the direction of a chart. So if you're looking at the Roro chart, for instance, UST against, let's say you're comparing US Treasury securities against the US 2000, or maybe you're doing any other comparison uh, uh, analysis. Maybe you're comparing the the government bond yield for one country to against another country, or whatever you're doing. Okay, so you can use the trend line to actually help you define a trend, or help you to spot early trend reversals, like what we have here. When the market broke this trend line to the upside here, that began to show us that the market is most likely going to go higher, and so you can see how it continued going higher for some time. And here it broke to the downside, and we can see how it's also so strong of going downwards. So it's not as if all the time you're going to have this happening, but it can help you, get the trend of the market and help you to spot those reversals earlier on. Okay, so that is a simple one. Doesn't really need too much of, of explanation. So you draw, if you're looking at the downtrend, you're drawing from the highs. Okay, so because if the market is going to continue, then it should keep on bouncing using the trend line as a resistance, and if it breaks it, and then we can say we are expecting to see bullish prices. And if the price is going high, so you have to connect the lows. Okay, so the price is making higher lows. Okay, so we can use that to say if price comes in there, we expect a bounce, but if it breaks, then we can say we are looking forward to seeing bearish more bearish prices, right? So the opposite of this would be the sideways trend line, which is simply those trend lines for support and resistance. This is your diagonal trend lines, and the other one is the horizontal one. So where you're looking at reference points. Okay, so let's say price comes in there, so that could be a weekly high, daily high. So that's why I mentioned that first of all. So that could be a weekly high, a daily high, a monthly high, or a yearly high. Okay, or the lows. All right, so that is for trend lines. And so if it is a weekly high, when price comes in there, you could be expecting to see it drop back down. But if it doesn't drop back, bang to the upside. If it breaks, then we can expect to see market come back in there and continue, or it might not even come back at all, but we just expect to see bullish prices, and then we can look for opportunities to enter, or it could just be that it's giving us a direction as to where to trade, or what direction we should be trading. Okay, so that is for trend line um, analysis. So the last one right here is the moving averages for all trend analysis as well. So you also have lots of traders who use moving averages. Now, the only thing that I don't love about moving averages is because they lag. And the longer the moving average, that's the longer the period of the moving average, the more it's going to lag. Okay, and that can be really dangerous for our timing of the market, but it is also a very beautiful tool in order to spot a market that is trending very strongly. Okay, so moving averages, actually what they simply mean is that it is it's a calculation of the average price for a set period. So it can be, if we're looking at 20 MA. All right. So what it does is that if it's looking at us, if it's 20 MA, it's looking at the average price of the last 20 candles, and then it plots it out on the chart. So as the market is closing, as candles are closing, it is shifting and giving you the last 20 candles plotted out, giving you the last 20 candles to plot it out. So that is for the 20 moving averages. So when price is below its moving average, it is showing us that price could be going down. So if price is below it and the moving average is pointing downwards, then we expect to see downwards prices. Okay. So some people use more than two or more than one moving average. They can use two, they can use three, and so um, in that case, they're trying to filter out bad trends because there are some times that you can have, you know, the market play a smartphone on them, and when they think the market is going up, it just goes down. So they try to use two or three moving averages in order um, to solve that issue. And so the popular moving averages that people use, the 200 moving average, the 100 moving average, but that's not here, the 50 moving average, and then the 20 moving average. Okay, so if you feel comfortable with using moving averages, then fine, you can use that. It makes things quite easy on your eyes. So when you see the moving averages like this, so let's say you plot two moving averages or three moving average. So the fast one, which is the one with a shorter period, in this case is 20 MA, when it is below the slower ones. So this is the shorter period MA, and this is the next shorter one, and then this is the longer period MA. So you can see that when the longer period MA is above the other ones, okay, and the shorter one is below the rest, then um, you say that the price is in a downtrend. And if the opposite is the case, then you say it is uptrend. So it can help you spot that, just define for you the trend very, very easily. Okay. And if the moving averages are, separating from each other, it is showing us that the trend is very stronger, very, very stronger. So like what we can see here, when the moving averages were separating from each other, 20 MA was separating from the 50 MA, you can see what was happening with price. The momentum was very strong, was very, very strong. But look at what happened here. When the momentum slowed down, right, you can see the moving averages beginning to come back together. Okay, so when the moving averages are moving away from each other and they are sloping upwards or downwards, okay, that means that the trend is quite strong. All right, so this is a basic concept again for analysis, so that you can easily find what is happening with your charts, because everything I gave you with the models, you have to bring it to charts. So you're looking at the risk on risk of model. You have to compare charts. You can look at volatility index. So when you look at volatility index, for instance, you can plot your trend lines. You can plot your trend lines, or you can use the moving averages in order to find the trend of the volatility index, and that can help you. It can just make things easier on your eyes. So you can use any of this to actually work. I'll see you in another video, guys. So cheers.